Hello, everybody. Welcome to a little introduction and overview of our new Economic Pulse newsletter. So let me take you through what we're offering in this newsletter so you can make an informed decision. So what is the newsletter? Well, basically, it's a fundamental risk on, risk off indicator. And what's unique about it, it's based on the economy, on the primary economic trend. And we use that indicator to form basically some tactical asset allocation models, kind of like Antonacci's dual momentum, that have higher returns and lower risk. And it's 100% quantitative, so that helps eliminate some of our human emotions that get in our way and a lot of the noise that comes out of the financial media. Why are we doing this? Well, I'll show you some statistics to show, and you probably know most investors can't stick with buy and hold, especially in the tough times. And in particular, buy and hold is not the best system for retirees. So when you're withdrawing from your portfolio, the volatility and drawdowns of buy and hold are very detrimental to how much you can withdraw in retirement. And for better performance, both in the portfolio and from ourselves as investors, we need to distinguish some way between what works and what's just purely noise. So the way we do it is we avoid risk assets during recessionary periods, which tend to drive corporate profits, which tend to drive stock prices, and other high-risk times. Most of the time we want to be in equities, and when those risk-off periods, we want to be in safe assets. And we want to do it quantitatively and not have our human components involved. So what's in the newsletter? Basically, we track the economy and financial conditions. The core component of the system is the comp risk indicator, and it provides us monthly actionable signals to allow us to make portfolio decisions. In simulations, backtesting since 1973, the comp indicator has identified every single recession within a month of their start. And it has also identified other high-risk periods of financial stress. So based on that, we can have a few effective, simple, 100% rules-based portfolios with the goal of maximizing risk-adjusted returns. So high returns, low drawdowns. And of course, to help us emotionally, we discuss the relevant financial topics of the day, scary chart of the week, or what have you, to help us stick with the system. So here's the problem. The problem here, this is a chart of the S&P 500 and drawdowns from its peaks over time, actually since 1967. And you can see these are monthly data points. So monthly drawdowns are typically can be 30 to 50%, particularly in recessionary periods. The gray bars are the recessions. So recessions drive corporate profits lower, which drive stock prices, also drives investor sentiment lower. There's some other risk periods, like you see here in 1987, but primarily we're trying to avoid recessions. Right? That's the problem. The other problem is just noise caused by financial media, and that's gotten worse in the last 10 to 15 years. So this is a great chart I found from a good blogger, Relevant Investor, and it shows you basically all the reasons to sell. Any chart, anytime over history, you can make 1,000 reasons to sell, and there's more and more every day. The perma bears are always out there telling you a reason to sell, and this is the bull market from March 09 to about March of 2017, and anywhere from the U.S. government shutdown to the Greek U.S. Debt haircut, downgrading of the U.S. debt, flash crash in 2010, et cetera, et cetera. There's always a reason to sell, and that affects you as an investor in your ability to stick with your plan. And so what that translates into, that volatility, that noise, translates into just poor performance. So this is stock market returns, S&P 500 versus investor returns. These are studies done by Dalbar. You may have heard of them. Basically, they look at dollar flows into and out of funds and ETFs. And you see the investors underperform the markets. Why? Noise, volatility, high drawdowns lead to poor investor behavior. We tend to do the opposite of what we're supposed to do. We tend to buy high and sell low based on fear. Or we just give up and choose low returning asset classes like bonds, where inflation is going to be very detrimental. So a mechanical automated approach can improve these outcomes for everybody. So the way we do it is primarily we're trying to avoid recessionary times. And we're not predicting, we're using current information. The modern term would be nowcasting, so to identify when the U.S. economy is at high risk of a potentially recessionary situation. And this is the model. It's a fancy statistical thing that we did, a regression that shows you how accurately the model would have caught the recessions going back to 1973. And we've back tested it even further. So if you subscribe to the newsletter, we have data going back to 1948. We didn't have all factors of the model, but the model performed very well even with less information. So that's pretty positive thing, and we think it's a very robust model. So the effect of that, if that works, this is a portfolio that basically switches between the S&P 500 and 10-year U.S. government bonds based on that monthly comp indicator. And so we go from a market where we get worst case drawdowns of 50%, typical drawdowns of 30%, to a system that you get worst case drawdowns of only 15%. That happened in 1987, to typical drawdowns of about 8%. So a very robust system, lower drawdowns, higher returns, makes it easier to stick to. And here's what it is in numbers. So there's a couple different models we run in the newsletter. There's a purely U.S. model that switches between the U.S. and the U.S. government bonds, and a dual momentum model that switches between U.S. stocks, international stocks, or U.S. government bonds in risk-off periods. And I've sorted this table by last 20-year returns, which is more relevant because a lot of these ETFs and asset classes didn't exist. The further you go back, the less reliable the data is. So I think 20 years is a good time period to look at this. And you can see the higher returns here in this column here, 20 years of these two portfolios that we run. Worst year performance, standard deviation, Sharpe ratios, these risk-adjusted returns are quite high. So you get higher returns, lower drawdowns, which leads to obviously higher wealth. And for retirees, higher withdrawal rates in retirement. These two portfolios, if you go back and run the numbers, historically, safe withdrawal rates are greater than 7% compared to a 60-40 U.S. portfolio, which gives you the famous 4% safe withdrawal rate. And even if those numbers are lower in the future, the relative difference between the two, we feel, will be maintained. And simplicity is important. So all these portfolios are implemented with very low-cost ETFs. There's several zero-commission options based on the brokerage. And also importantly, they're low turnover models. Both these models, SPY Comp and DM Comp, average only about 2 trades per year. If you look at a lot of TAA models, they turn over quite frequently, and that also makes them harder to stick to, and you pay more taxes, etc. These are some of the important features. So basically, you get two fundamental aspects in these models. You get obviously the performance aspects. You get better performance. You get lower drawdowns. And better performance makes it definitely easy to stick to in good times, right? One of the problems is performance chasing. So in a bull market where the indexes are going up and you're in some strategy that's not linked to the index, if you're underperforming, you tend to chase these markets, which leads to poor outcomes a lot of times. And obviously lower drawdowns makes it easier to stick to in tough times. Higher withdrawal rates, low turnovers, which mean low fees and lower taxes. But just as important is the behavioral aspects of the model. Simple and transparent models, you don't want a model that's difficult to understand and hard to implement, because again, it just leads you to higher chances of failure. And this is especially easy during tough times, when the market is down 6% in one day or over 10% in 1 month, which will happen, always has. Having a model you understand and are confident in will make it much easier to stick to. So we're trying to do both things in this system. So what you get in the newsletter is you get actionable signals on a monthly basis. You get the main comp risk indicator updates. We track the actually three right now, TAA investment models, and we'll be adding more in the future. I don't want to get too complicated, but there are some enhancements we could do. And on the analysis and commentary of the current economy, what the investments are doing, etc. Simple, easy to use website. You get portfolio updates broken out, so you don't have to go read the newsletter in detail all the time. All the historical information, etc. I'll send a weekly email update of just what happened during the week to keep you up to date, and you get that for $25 a month right now. The normal price will be $30, but for now, don't know how long yet, but $25 a month. And who are we? Why are we doing this? Well, I'm the author of the Investing for a Living blog, which maybe you clicked into the screencast from, and I've been writing my blog for 8 years and counting. And I've been living off my portfolio since 2006. I have a technology background, 15 years in the semiconductor industry, an electrical engineering background, and then went to school to study investment management. And you can read more about me on LinkedIn. And I have a co-author, Tony Alvarez. He's kind of my statistical expert, does a lot of the econ indicator stuff, business process guru. He's written a recent book, Managing Business Process Improvement, which I encourage you to check out if you're into that stuff. 40 years in the tech industry, executive positions, board positions, just a real value add, and it's making the newsletter and the blog a lot better. So I encourage you to check it out. I think you'll be pleased. And that's it. Send me an email with any questions you may have.